he said, I have a very important announcement to make today that I'm going to sell the business. And there was a hush over the crowd and everyone sat down and there was an envelope on the table in front of them. And he says, the identity of the new owner is inside that envelope. Would you please open it now? And they opened up the envelopes and inside it was a small handheld mirror.
You're listening to One Way Out, the podcast for business owners ready to build smarter, protect what they've built, and exit on their own terms. Hosted by Dan Prisciotta, managing partner at Equity Strategies Group, fellow business owner, and the author of One Way Out. In every episode, you'll hear honest conversations with experts and entrepreneurs about the decisions that matter most, the ones business owners don't know they need to make until it's almost too late. So if you've got most of your wealth tied up in your business and you're thinking about what comes next, this show is for you. Let's get into it. The information shared on this podcast is for educational and informational purposes only and does not constitute financial, legal, or tax advice.
So welcome to our podcast, One Way Out, How to Grow, Protect, and Exit from Your Business. I'm your host, Dan Prisciotta, and today we are very fortunate to have as our guest Rick Jaye. He's the managing director of BTA, Business Transition Advisors, a firm that specializes in ESOPs, employee stock ownership plans. So just to set the stage very briefly, our show is going to address, as the name would imply, how to grow, protect, and exit your business. But we're going to talk about a number of strategies that should appeal to business owners in terms of connecting the dots between their business and their personal financial lives so that they can make it all the way home. And we often talk about 5 different exit strategies. One is to pass it to family members, and there's a variety of ways to do that, which we'll cover in future episodes. Second is to transfer it to a partner or a co-shareholder if you have one. Third might be to transfer your business to your employees, whether they're key management or all the rank and file employees, through a vehicle such as an ESOP, which we're going to dive into today. A fourth exit path would be to sell your business for top dollar to a third-party buyer, whether it's a strategic buyer in your industry or perhaps to a private equity or financial buyer. And then the fifth is, of course, an IPO, which really doesn't apply to too many of the middle market businesses that we work with. So, you could even say there's really 4 exit paths. But one that's become very, very popular that we hear a lot about is the ESOP idea. So today we're going to dive deeply into that topic with Rick Jaye. Rick and I have known each other, we're friends. We've worked together for at least a dozen years. We've worked on a number of ESOP transactions that have worked out very, very well for the owner, for the employees, for the business, for the community. So Rick, welcome.
Dan, thank you so much for the opportunity.
So Rick, if you would, for our audience, give us sort of an introduction to ESOPs. What exactly is an ESOP?
Well, an ESOP is an employee stock ownership plan, as the acronym denotes. And the benefit of the ESOP and the attributes are it's a qualified retirement plan in its very foundation.
Like a profit sharing or a pension plan?
Mm-hmm. Very much so. It's a qualified plan sponsored by the corporation or the business for the benefit of the employees as a foundation. The key difference of an ESOP as a defined contribution plan over other plans is one is it's non-contributory from the employee's perspective. So they're just simply by working for the company over time as a full-time employee are going to be granted stock in the company.
And that's unique.
They're very unique.
So the asset is not mutual funds or other stocks, bonds. It's primarily one security, which is the company they work for.
And the positive of that is they have employees that are part of an organization that is an ESOP tend to take a strong ownership mindset. The companies that are ESOPs tend to be better performing than their peers because of the fact you've got employees now have a vested interest as owners of the company and benefit from the ongoing success.
Because now the employee is also an owner, so they're going to be a little more conscientious about turning off the lights, making sure that there's no waste in the business.
Managing theft among other
not
employees.
Walking out with product. Correct. Exactly right.
Correct. And so from a societal standpoint, one of the characteristics that make ESOPs very attractive is, and you talk about the idea of exit planning. I sort of take offense in a positive way. Not that I attack the idea of using exit planning, but so much of our industry talks about the exit planning. There's credentialing you can get from organizations like BPI and EPI, and they're wonderful educational and credentialing organizations, but everything's focused on exit planning. And having been a business owner multiple times, having exited those businesses multiple times, being an ESOP at BTA ourselves. And
your firm is an ESOP
we are what
company.
As a client once described to me, he said, you eat what you kill.
Exactly.
So the nature of that is we strongly believe in what it does for the organization. There's obviously, we're going to talk about some of the huge tax benefits around that. But I find that as an ESOP company, everybody really focuses on acting, behaving as a responsible business owner.
And growing the business.
And the other side is it tends to create a stronger retention strategy, which is critical in our society as a company.
And recruiting, right?
Because as an employee of an ESOP,
you want to just bring in people who are going to help grow the business, be good stewards of that business, right?
Because it directly impacts you now, because the better the company does, the greater their stock value, the more your retirement benefits. So.
Exactly. And I want to go back to the somewhat controversial comment you made a moment ago, which I agree with. You could say it's not an exit strategy insofar as the business owner is not going to get a big check and walk out the door the next day. So there's usually a bit of a connection to the business for some period of time. How does that work, Rick?
So in the world of ESOPs, fundamentally there's two ways of doing it. We're going to really focus today on what they call leverage transactions, where there's a liquidity transaction that benefits the shareholder.
So leverage meaning there's some borrowing that's involved. Either the ESOP plan is going to borrow from a bank or a lender, or the owner is going to act as the bank and take back some kind of a note.
Correct. Or a combination of both. And so from that perspective, I talk about when you look at, when you do the analysis, and there's many studies that have been done about mid-market business owners in this country, companies that are worth between 20 million to as much as $1 billion. And you're in the private sector space, and you look at the clients that are in that space that own those businesses and their net worth. It's amazing on what percentage of their total net worth is tied up in the equity of the business.
I see 70-80% of their net worth is tied up in the business and or the business-related real estate.
I think the actual statistic is around 93% of the family's net worth is tied up in the illiquid assets tied to the equity value of the business, and sometimes the real estate that supports that business. So when you look at that from my perspective, which is why, exit planning is a part of succession planning, but I think when you solely talk about exit planning and our industry focuses on that, you're actually missing 50 to 60% of the opportunities. And maybe it's unique in the context of the business owners that I do work with or I come across, and I have opportunities to talk to advisors that work in that space that have business owner clients that I speak with. When I ask the question to those business owners, what are your overall objectives and what are you trying to achieve? And is it the intent of walking away from the business? I find the vast majority of those that at least I experience and talk to, their business is their baby. It's their family.
It's their identity. It's their worth. I get it. I have clients that say, I've been working here since I was a teenager. And what else would I do with my time? Yes, I have some other interests, but this is my passion. And I can't turn it off.
As you and I were talking about earlier, there's, as we get older, our bodies can only handle so much golf, so much fishing, so much hunting. And so I
can handle more.
Yeah. So our enjoyment, our fulfillment in life and our satisfaction sometimes outside of the balance of our family and the things we love to do
is from the business itself.
From the business and the joy that we get. And one of the questions I think is part of the discussion is, why is the ESOP as a fundamental instrument to create liquidity, create the succession capabilities, and give the owners the option over time. If they want to phase out, they want to stick around, they maintain that level of control.
Maybe have a board position, maybe pull back from the day-to-day grind, but still be involved in the strategic direction of the company, be the face of the company, and so forth.
And watch the legacy that they worked hard to build be perpetuated. And getting back to that point that we were originally discussing of, why is it growing? What are we seeing?
Why is it so popular? Everyone, I get calls all the time, I've heard about an ESOP, Dan, can you tell me more about it? Or my CPA suggests an ESOP because of the amazing tax benefits, which we'll get to in a moment. But you know what we might want to do, Rick? Why don't we step back and explain what exactly, in simple terms, is an ESOP? We can talk about all the virtues, the advantages, disadvantages, where it fits, where it doesn't. But first of all, what is this thing, an ESOP?
Yes. So fundamentally, as we said, it's a qualified retirement plan that as an asset will hold stock in the underlying company. And that stock then gets allocated to employees based on a formula, whether it's a compensation-based formula or it's a point-based formula based on length of service with a link tied to compensation. And all the employees that are eligible, full-time, typically over the age of 21, and that allocation takes place over long periods of time. So you're incenting employees through their retirement plan and through their retirement benefits to ultimately receive a much higher ultimate retirement allocation and benefit in the form of total dollars.
Let's walk through a quick example, okay? So I own 100% of ABC Manufacturing Company, and I considered selling it to a third party, considered, for whatever variety of reasons, considered, family succession, but my children are involved in other careers. They don't want to come into the business, let's say. And I really feel an attachment, a loyalty, a responsibility, gratitude, let's say, to my employees. And I want to continue that culture that I've created over the years with the business, with my employees. And I say, okay, I want to create an ESOP. So now, as an owner, what are my next steps? What am I doing to get the stock in the business to my employees?
So the process is normally when we talk about a leverage transaction is, taking all the complexity of the transaction and all the pieces. The company goes out when it's talking about a bank or senior financing to get cash out at the time of closing. The company will go out and finance drawing and borrowing money. The corporation
and
then...
you kind of arrange that, you'll bring in the banks, bring in the lenders to effectuate that loan to acquire the interest from the owner.
We do, and I think a lot of the firms in our industry that have that capability can secure bank financing for the client. Yep. There's limitations under Dodd-Frank on how much money can be borrowed based on the overall value of the business, but needless to say, there's cash that can be borrowed up front that is cash that comes out to the selling shareholder at the time of the stock sale.
Okay. So I'm selling my business interest to an ESOP trust, and I'm taking back a note if I'm going to finance, or if the ESOP got lending from a bank or a lender, they now take the liability and are able to pay me, or a combination.
Yeah, for all intents and purposes, that's the way it works. It's a little bit of a twist. The ESOP doesn't borrow because it doesn't have the ability to generate income. The corporation does. Yeah. So banks and or owners that are selling their stock, if they're taking back a seller note, usually don't want the ESOP to be the borrower for their capability of getting cash, simply because it doesn't have a means by which it can earn income.
Right. It's the business that's generating the income.
The semantics are the corporation is redeeming and buying the stock back from the shareholder, getting bank financing with seller note financing, and then through a separate internal transaction, the corporation then transfers the stock into the ESOP. So now the ESOP actually owns the stock and holds it to release that stock to employees. And then in turn, the ESOP creates a loan agreement between itself and the corporation. So it's semantics. So when people describe, just as you did, that the ESOP is borrowing and securing, in reality it is, but because of the protection that banks want, so if the company defaults,
right.
An ESOP is a qualified plan under ERISA. It gets technical. You can't go back and sue. A bank can't collateralize to go back and sue an ESOP because it's judgment proof as a qualified plan. Okay. So hence a corporation is the entity by which it's going to loan the money.
Well, let's continue to kind of walk through the transaction. So I'm the owner of the business. I'm going to sell it to the ESOP. How do the shares of stock get allocated among the employees? Who gets more? Who gets less? How do they get it? How long does it take for them to vest in those shares and actually have the benefit of ownership?
Common question, and it's very good to at this point in time discuss. So first of all, vesting, usually it requires, like all qualified plans, a period of time for eligibility. Normally it's a 1-year wait. And there's 2 entry dates, January 1 and July 1, when you enter the plan and then start receiving stock allocations. Even if you receive stock allocations, though, we usually design the plans, and it's fundamental in the industry. Like any qualified plan, you typically have either a 3-year vesting or a 6-year vesting. Most clients elect the 6-year. Yeah. So it's 0% for the first 2 years and then 20% each year thereafter. At the end of 6 years, you're 100% vested. So what that means is all the stock you've been granted each year, you now are entitled to the economic value as a retirement benefit of what that stock is worth.
So it's in your plan. You can't discriminate. So all employees, as you said, over 21 full-time workers, and then the allocation is based on what? Their compensation levels? Or so the more highly compensated people are going to get a larger portion of the company stock, say, than someone that's lesser compensation, but everyone joins in.
Everyone that's full-time and that's eligible. And again, under qualified plan rules, there is some discrimination capabilities as long as you follow the non-discrimination rules. My attitude is that you don't want to create an environment in the company where you have the haves and have-nots. You want everybody to benefit.
Everyone to participate. Everyone's rowing in the same direction towards a common goal.
Yeah, the concept of a rising tide rises all ships.
Exactly.
You want everybody to work effectively because that hourly new employee that you hire might turn out some point down the road to be a key person in the company 15, 20 years down the road and could grow into the capability of becoming the new president. So you don't want to discourage by having an environment where you create the have-nots mindset. But I also want to address that question about how you allocate stock, because that's an important one.
It is. Yeah. And so I'm an employee. I want to know how am I getting stock in this company?
How do I get stock compared to you in the company?
Yeah.
There's really 3 fundamental ways you can do it in ESOP. First is, as you described, compensation based. So it's purely just like a profit sharing plan. If you make $200,000 a year and I make $100,000 a year, and it's purely compensation based, you're going to get twice the amount of stock allocated every given year that you have the double salary that I have. That's the most common way. But in addition to that, we have a lot of owners that really have, they're not the highest paid people, but they feel this tremendous loyalty to the people that have been with them that were involved in working for the company when they started it or worked for the prior owners and have continued this legacy within the business. Yet they're maybe not the most valuable people because they're not driving the greatest profitability, but they're important.
They're all important.
And in that case, there's a way you can design it. We call it a point system where you allocate a certain number of points for every year you've been with the company since inception of when your hire date was. Perfect example, let's assume you give 10 points for every 1 year of service. So if you've been with a company 20 years, 10 times 20 for the number of years is 200 points. And then you can allocate 1 point as an example per $1,000 in comp. So if you earn $50,000 a year, that would be
so it's
200.
Tenure as well as compensation to come up with something that's fair and equitable for everybody.
Now you have to treat everybody the same. So you can't say, Dan, we're going to give you 10 points for every year of service and only give me 5 points. So you're following the same allocation for everybody.
Across the board.
But that tends to weight more of an equitable benefit based on the length of time.
Right.
And then the third way is you can provide an equal allocation across the board. So BTA, our firm, we are an ESOP, 100% employee owned, and uniquely the way we did it because we feel in our company everybody creates value. The highest paid people are obviously those that are driving revenue and signing up transactions and working with business owners, but that doesn't mean they're the most valuable. And so we have what they call an equal allocation.
Takes a team, Rick.
Yep. So, whether you're that canoe, you're the person with the loudspeaker and telling everybody, when they're supposed to put that oar in the water and row, they're just as valuable as the lead coxswain that is driving the boat. So, from that perspective, we designed it as an equal allocation. Rarely have I seen that done, but those are the 3 methodologies, and they're flexible in the way that you design those.
Terrific. So let's talk about the advantages of an ESOP. We're touching on it, but let's look at all the parties affected. So let's talk about the advantages of implementing an ESOP for a business owner. So first, the one that always comes out, the big headline, is the tax advantages.
Well, the one great thing about an ESOP is since it's an internal sale, it's a friendly transaction.
This is true.
So you've been through, and
you don't have the investment banking, butting of heads, due diligence, haggling, and so forth. Right? You're dealing at a friendly. Although there's trustees, there's lenders, right? So and you have to respect all of the rules.
Yep.
The IRS, the Department of Labor, ERISA. So there are certain rules and compliance. But having said that, let's say I own a regular C corporation. Okay. And I decide I look at all the options and different exit paths, and I decide, you know what? I really like this ESOP concept. I want to sell my C corporation to an ESOP. And let's say my basis when I started the business 35 years ago, my basis was $10,000, okay? And it hasn't changed much. And now the company is worth whatever, 10 million, 20 million, plus. If I sell my business to an ESOP, do I have to pay a big capital gains tax?
So as a C Corp, as you know, one of the big advantages is there's the IRS tax code section called 1042. The positive is for those that aren't experienced with ESOPs, and I'll explain 1042 briefly, but you're probably familiar, if you're in the investment or insurance world, you're familiar with 1035 exchanges for life insurance, or in the real estate world, 1031s.
1031.
It works the same way. Those code sections are written. You could simply replace the term life insurance with real estate with ESOPs. And the language of the IRS code section and the way they're treated are almost identical. You can, when you do an ESOP transaction as a C Corp and you sell 30% or more of your stock, you can elect 3 months prior to the closing of the stock sale of the transaction and 12 months after to elect 1042, and you can reinvest a portion of your proceeds to postpone with the intent of ultimately eliminating your state and federal capital gains tax.
And then when you roll it over, so let's just say I get, $10 million, I roll it over into qualified replacement property, and there's specifics, but it's not a tough threshold, right? I mean, we've done this before where it's essentially a portfolio of domestic stocks and so forth.
And fixed income bonds.
And fixed income. So it's a nice portfolio that most owners would probably reallocate into anyway.
Correct.
And now they can enjoy the interest, the dividends and so forth on that portfolio. And then if they hang on to it forever, through lifetime, then they pass it down to their family, get a step up in basis, and no one ever pays a capital gains tax.
And you're also in that scenario when you're looking at the overall planning, you're almost guaranteeing and assuring a wealth transfer capability because the portion of assets held in the 1042 that have been put in place initially to secure that ability to postpone and ultimately eliminate the capital gains tax upon death, the family sells out all those assets. They pay off any margin or liquidity loan tied to that. The balance goes to the family, the inheritance of the family, and a step up capital gains with no capital gains tax.
It's a home run.
If you've spent everything else over your lifetime, what you've done is secured and guaranteed at least some portion of the original value of the business being passed on to your heirs.
From avoiding, deferring capital gains tax, ESOP's a home run. Let's look at the other types of entities. Right? More and more we're seeing S corporations and LLCs, limited liability companies, pass-through entities. So now when you sell your business to an S Corp, you sell your S Corp or LLC to an ESOP, yes, you have the capital gains exposure, but now you have an ESOP owning that pass-through entity. So you've now created an income tax-free company for the life of that company. Correct, Rick?
That is correct. I mean, you've been through this, and obviously you know that, and that's one of the big strengths that when you evaluate purely from an economic standpoint, an ESOP transaction versus any of the other methodologies, the economics, because of the efficiency of being a tax-free organization and covering the debt obligation to pay off that debt with theoretically what was previously being sent to the IRS to cover the tax liability of the shareholder, either as a partner getting K-1 income through the LLC or as the K-1 recipient of an S-Corp. The fact the company is tax exempt and no longer paying taxes on all its profits.
Tax exempt company.
In a place like New Jersey, New York, and California, where you've got, for all intents and purposes,
federal plus state taxes,
you've got close to 50% marginal tax rates. You're simply paying off the purchase of the company through the tax savings on an ongoing basis over the next 7 to 10 years, and then you're giving the company to the employees.
So now you created the tax-free company, Rick, right? What have you seen businesses do with the money, the cash flow that they were previously shipping off to the IRS? Now there's millions of dollars of taxes year in, year out that are being saved. What do you see companies doing with those tax savings?
Well, threefold. The first thing is what oftentimes happens, the typical model of an ESOP is you're paying off the debt based on a full fair market value, because that's one of the big advantages.
So pay off the debt quicker.
They're in a position now, and most bank financing or senior debt financing you put in place, the banks have a normal amortized structure with the requirement annually of accelerated principal payments once a year based on excess cash in the balance sheet. So there's usually an automatic automatic acceleration of the debt payments with part of that tax savings and part of the excess cash in the balance sheet. But more importantly, one of the important characteristics of the legacy to protect the ongoing success of an ESOP, and especially when you start, and we'll talk about some of the companies, examples of companies that have been immensely successful that have done ESOPs, and the burden of what it puts on the business to cover the future obligation of buying the stock back when employees retire, because employees don't take stock with them. Doing an ESOP, one of the big advantages for the selling family and the shareholders is you're not selling stock directly to the employees, so they don't have what they call minority shareholder rights. They don't vote the stock.
Which is great, because most owners, and I endorse this, you don't want to create a whole slew of minority owners. And that's a great point, Rick, because a lot of owners will say, well, gee, if I do an ESOP and I create 150 or 30 minority shareholders, can they have the right to inspect the books and come into my office and tell me how to run the business? The answer, of course, is no.
Correct. It's employees don't directly own it, the stock, which is important, and it's a key driving characteristic of an ESOP over just granting stock directly or selling stock
and
outright.
they don't have to recognize any taxable income right away.
They have no liability exposure to the
That's right. They're
business.
not on the hook.
They don't have tax liability currently. They'll ultimately have to pay taxes as any qualified plan. Distribution takes place when they retire, they die or get disabled. There is a tax consequence for money that isn't rolled over to an IRA. But the key is they don't own the stock. They don't have minority shareholder rights. The board of directors in the structure of an ESOP will have ongoing control of the decisions of the business.
And the owner can serve on the board.
We would strongly urge the selling shareholders to sit on the board and control the board.
Right. So can still have a say in how that. So even though they're divesting themselves of stock and having something of a liquidity event, they still have very much a strong voice in how that business is run.
Correct. And now the key is they have what they call fiduciary liability on the board,
yes.
Meaning that today
Which
you
they
own the business.
probably could buy some kind of insurance for to
yeah,
protect
you buy
themselves.
D&O and E&O insurance is protected, but still it doesn't mean that you misbehave and not follow proper prudent practices. Compliant, when you have to follow compliance and governance requirements, which simply means you own the company today. So Dan, you have a company, you own it. You can choose to do whatever the hell you want with that company for all intents and purposes. You got extra cash on the balance sheet. It's your piggy bank. You can take a distribution anytime you want. As long as you cover your tax liability by the year end, you control those decisions. When you sell to an ESOP, you've created a tier of owners, which is the ESOP trust. As a qualified plan, there's fiduciary rule. The board now has authorization to run the business the way it chooses to, as long as, again, it's not making decisions that are harmful to the value of the company and are not creating a breach of fiduciary responsibility. So you now sell to an ESOP and you decide that you'd like to buy a brand new Ferrari, and you don't have the money in your bank account, and you're waiting for your distribution check. So you go back to the company.
Can I use
you go
the
to the
corporate assets to buy the Ferrari?
Yeah, no.
But it's essential to the operation of the business.
Yeah, well, it might be if
I'm
you're
entertaining clients.
or maybe you're in the F1 business.
Or a yacht or something.
But the key is, you just have to look out for what is in the best interest of the company to drive the value of the business. And what I suggest to owners when we talk to them initially about what the strengths and weaknesses are, if you can't keep your hands out of the cookie jar, then don't do an ESOP.
That's right. And where I was also going with that question, Rick, was once you create that tax-free company, the company is an S Corp or an LLC, it's now owned 100% by an ESOP. Company no longer pays income taxes, not at the state, not at the federal level. With all that freed up cash flow, can't they now use those millions of dollars and put it back into research and development, recruiting, getting new people, paying bonuses? What else? Buying machinery, equipment.
Putting into investments, buying insurance. Because one of the things
instead
is
of the money going out the door to the IRS, it's being used in the business to grow and perpetuate the business.
Correct. And so, again, one of the big obligations an ESOP has, and unfortunately, I get calls probably once a month from current board of directors of companies, not that we've done the transaction, but that have been done in the industry. And they call and they say, we've heard you're good at in what you do, and we're looking for some guidance and help. And I said, well, tell me a little bit about what you're trying to accomplish and what the issues are. And time and again, it's a successful ESOP company. It's 12 to 15 years down the road. They've paid off their debt. They're doing quite well, but they have a huge repurchase obligation that's coming due in the next couple of years. I mean, I'm talking about, 20, 30, $40 million of retirement payouts.
So let's just back up there.
Well.
So now the owner sold the company to the ESOP, took back a note, took back cash, now kind of, moving down the road a little bit, still being involved. The employees are benefiting because now they've got ownership indirectly through their ESOP shares. Fast forward, as the employees' balance in the ESOP plan increases, how do they have a liquidity event? Through retirement, or if they die or become disabled, not as pleasant, or if the company is sold, right? So how does the company meet those obligations to buy back the ESOP shares from those shareholders?
Well, the selling is a little different scenario because a buyer obviously would come up with cash and buy out the stock, the stock from the employees,
which is
and
an
they get a
interesting
windfall.
Point. Right. So creating and selling to an ESOP is not an irrevocable decision. If down the road a decision is made to sell the business to an outside buyer, well, you can always get at it, unwind the ESOP, sell it to a third party, and people take cash for their ESOP ownership interests.
Absolutely. I mean,
that's not the design going in. So now, everything is working very, very well. I have this ownership interest, and now I get to retirement age, and I turn to the ESOP trust and say, hey, on paper, I own all these shares. How do I create a liquidity as an employee? How do I have a liquidity event?
So as an employee retires, meets the requirements of age 65 or older, has been with the company for 5 years or longer and retires and is entitled to having their stock redeemed. They don't take stock with them. Again, we're not making a public market for this stock.
You're not rolling it to an IRA like a 401k when you leave.
Nope.
You're being bought back.
You're getting cashed out. The corporation then buys the stock back, or the ESOP itself, if it has cash or you make a contribution in cash to the ESOP, it actually redeems and buys your stock back. So you get cash as a retirement payout, no different than you would get in your 401k or a profit sharing plan or a defined benefit. Merry way. And you can now roll that to an IRA as an individual, pay no taxes on the rollover, and manage your own distributions. Right. But the company has to be able to redeem and buy that stock back.
And most importantly, if everything is worked according to plan, the value of my ownership interest in the company has gone up significantly.
Significantly. I mean, there's examples. And as I said, I get calls once a month. And unfortunately, when I help the board of directors understand what that obligation is, it's so vast. Their choices are they re-leverage the company, which then has a negative effect to the value of the company stock when you put more debt on the balance sheet. And that's not going to make people that get their statements the next year that see a reduction in value too happy. No. Or you put the company up for sale and you sell it out to a third party.
Well, Rick, give us some examples of well-known companies that have implemented ESOP plans and have experienced tremendous results.
Probably the most successful one, and one that's dear to my heart, is Publix shopping centers. So for anybody that is familiar with Publix, and that's an East Coast, started out in Florida and has migrated now as far north as Virginia.
You live in Florida. You were involved in that?
I was involved in their transaction, but I sat on a board with an of another company.
And you sit on the board of what, a dozen different ESOPs?
Correct.
You started out as an entrepreneur, so you've been on that side of the table. You're obviously an ESOP specialist in terms of designing and implementing ESOPs for business owners, and you also sit on a dozen or so boards, so you get to see the good, the bad, and the ugly.
Yeah, fortunately,
how these plans operate.
Yeah, knock on wood, all the boards I sit on and have sat on have all done quite well. So
I'm sure.
Maybe I pick them right, or
you make sure that they're working the way they're supposed to work.
I just get involved in doing good deals, and so I don't want to do a transaction. And we'll talk about that in a little bit about the philosophy of owners. But I'm adamant that if you're going to do an ESOP, and maybe this comes from the philosophy of BTA's mission statement is to do well by doing good. And part of that is to make sure if we're doing an ESOP, it isn't solely about the money for the family and the shareholders. No. It has to be the balance of, it's got to be good for the employees, it's got to be good for management, it's got to be good for the customers, it's got to be good for the family and fair.
Right.
But it's about protecting that business and the legacy and the culture of the company.
So Rick, let's talk about who is the ideal prospect, ideal candidate to implement an ESOP. There's the right mindset, right? Someone who wants to perpetuate that culture, give back to their loyal employees, perhaps who kind of got them to where they are with the success of the business. But aren't there also certain industries that lend themselves and certain other business characteristics that make an ESOP an ideal fit?
Yeah, absolutely. When you have the alignment, and that's and you've heard me on many calls, when I talk to owners, I spend as much time, once I understand the fundamentals of the business, we're looking for at least $2 million or more of EBITDA, earnings before interest, taxes, depreciation,
net
amortization.
Net profits. Cash flow.
Yeah. Correct. We want to make sure it's
There's
$2 million or more.
There's got to be enough cash flow to support the ESOP transaction.
And a benefit so that there's enough. Banks usually have limitations on how the company has to be successful enough for them to be able to lend to it up front.
Right.
And if you want to do the 1042, you got to come up with cash at closing to support the reinvestment of dollars to avoid the capital gain. So we want we want the company to be big enough to be able to qualify.
Yeah, just one other point too, leadership succession. I've had a lot of owners reach out to me and say, hey, I've heard about the ESOP. I think I'm enticed by the tax advantages, the advantages to the culture of my business. But then they say, well, once I retire, I'm out the door, I'm gone, goodbye. Well, tell me about your leadership succession. What does your organization chart look like? Is it flat or are there layers? And is there someone or a group of managers who can step in and do what you've been doing? And sometimes they say, no, there's not. So are you doing your business, your company, and your employees a favor by handing it over to a non-existent or inexperienced management team?
Well, and that's getting back to what makes, when we're talking to clients, what makes a good ESOP candidate or not. Part of it is getting an understanding of that comment. Because if an owner truly wants to exit, let's get back to the difference between succession planning and pure exit planning, or de-risking or liquidity planning and exit planning. If an owner wants out, that most likely is not an ESOP transaction. Even if they love their employees, they love they have great culture. If they want to walk away from the business.
And there's nothing wrong with that. The owner who says, listen, I want a big check. I've been working hard for 20, 30, 40 years. This is my opportunity to cash in, and I think the timing is right. I want to get maximum value, and I want to be done. Probably not an ESOP candidate.
Yes, and the reason behind that is, again, you're not getting all your cash up front in an ESOP because there's only so much we can get from senior lenders. So you're taking back a long-term seller note, like a second mortgage on a house.
How many years usually on that note? 6 years, 7 years?
Well, it's usually designed from between 8 and 12 years.
8 to 12, but you can accelerate it.
But you accelerate it, you can refinance it. But still, if you want to walk away today and you're only getting 30% of the sale price up front through an ESOP, you're taking on too much risk. If you're turning it over to a management team that hasn't demonstrated they got the ability to run the business.
You've got to stick around and protect your investment.
So that's why part of the discussion with business owners and understanding what is the right fit is understanding what does the management team look like. And maybe you don't have the perfect person today, but you're willing to stick around for 3 to 5 years. The idea is in that 3 to 5 years.
And that's what you do to grow the business. If the goal is to sell to an ESOP, you use that runway to go out and build that management team so that it'll allow you to sell to an ESOP.
Yeah, or you do the ESOP up front to get the motivation of the management team to,
that's true too.
To be highly motivated,
it's
to step up.
It's a great recruiting tool as well as a reward.
Because let me address this one point. The reason why that can be effective is it's still, doing an ESOP doesn't limit your back-end theoretical sales. So as we talked about, I sit on a lot of boards. I've sat on boards of ESOP companies, specifically 5 in the last 3 years, that we ultimately sold those companies because...
So it started as an ESOP.
The ESOP was doing exceptionally well. And then you saw an
opportunity to sell. Was it because their objectives changed or somebody made them an offer they couldn't refuse?
Both. In a couple of cases, their objectives changed. The owners that were still operating and running the business had made the decision because of the success of the company. A lot of the debt had been paid off. They saw the end of the runway that they wanted out, and nobody stepped up to the table that truly had the ability of running the business.
Back to leadership.
So in essence, we were able to take the company to market, sell it at a significant premium over its current stock value, and that made sense.
Not the worst thing that could happen.
And it was great for the employees because now they get a full liquidation of all the stock value that they've got within the ESOP. So
if they're ready to retire, they move on. If they're not, they got a
massive windfall that can be rolled over to the new company's 401k account. They've supercharged their retirement benefits, and it's a win-win-win across the board that way.
Very cool.
In the other cases, when we talked about ESOP companies become very highly desirable third-party acquisitions in the marketplace.
I could see that.
Because
they're so attractive.
Studies that have been shown from
knit.
University of California, San Diego, the BISIS Institute, which is a graduate program that studies ESOPs, Rutgers University up here in New Jersey, that has a graduate program that studies the impact of ESOPs on companies in America. You've got Ohio State, you've got Keene State. They've demonstrated through studying ESOPs all the way back to inception since ERISA passed in 1971, what the impact has been. And ESOP companies, and this is their studies, not ours, show that when companies implement ESOPs, a number of things happen. Their top line revenue grows between 2 to 4% on average above their historical growth rate.
Because the employees are owners, they care, and they're going to work hard and double down.
Correct.
Yeah. It's a very well-run company now. It's going to be more efficient.
The net profits and EBITDA increases of between 3.2 to 4.7%
They're keeping an eye on expenses. There's less waste.
People are mentoring. Today, I work for you in your division of the company, and, I do my job, but I'm waiting for my paycheck. I'm not putting in much extra effort, and I'm not being probably as efficient as I could be.
You didn't quiet quit.
And
you didn't retire on the job.
You're my manager, but you may not take a lot of effort into mentoring me to try to make me better at what I do. But once you're an owner in the company through the ESOP, what happens is the mindset changes.
We're in the same boat.
You want me to be better at what I do. You want me to follow safety standards. You want me to follow prudency.
And if you slack off, you're hurting my bottom line. So we're going to have a conversation.
Correct. And that happens time and time again, which sort of, again, that idea of the rising tide rises all ships, where everybody's rowing in the same direction. And you see that consistently. I was at a shareholder board meeting yesterday in Louisville with a company that we did a transaction for 4 years ago. And our original model projection was that as of last year, the stock value was going to be around $18 a share. Based on the original forecast, the growth rate of the company, we delivered a share value for the closing year of 12/31/2025 of $30.35.
Wow.
What is that, about a 45% stock value increase in 1 year?
Amazing.
And that's happening because the company's doing better than it was previously. They're driving more sales. They're focusing more on managing waste. As a manufacturing company, they're managing waste better. They're focusing more on safety. Their workman's comp rates for factory employees have dropped pretty dramatically. I mean, all the things that happen when you do an ESOP tend to take place with the companies.
So you've covered very well the benefits of an ESOP, how it improves the company and so forth. We were talking about the ideal candidates. So the right mindset, having a strong leadership team. Are there certain industries that tend to adopt an ESOP? And then flip side, which industries or type of businesses might not be a good fit for an ESOP?
And it's a great way to ask the question, because everybody likes to talk about all the wonderful things about everything that they sell. So ESOPs, where they fit ideally is in outside of the discussions of what we talked about, the emotional, the feel good concepts that owners want to protect. The idea of industries, construction, and anything related to construction, manufacturing and everything related to manufacturing, service-oriented industries. The reason why is because typically private equity.
Well, professional services too.
It is, but there's certain rules.
BDO, big accounting firm, they went ESOP recently.
I think Markham was another one that
is
went.
That right?
Markham, I think, is an ESOP. I think they went.
A lot of
ESOP.
Architectural engineering firms.
Correct. It's huge in the architectural space. It's huge in the engineering space because they're people driven. They need to capture and
it's
keep
not
their
capital
quality.
intensive. It's
Correct.
people intensive, and they want to motivate people.
And private equity isn't interested in paying a 12 to 15 to 20 multiple for those companies. And
so that gets to who's not a good candidate. If you're in the high-tech business and you can get an outrageous multiple, just sell the business, cash out, move on.
And you can take as in with what you do. We don't do it, but there are wonderful ways you can help owners of businesses take care of key management when they do a transaction like that. I mean, one of the companies years ago that I was a principal of and a founder of, we sold it to a private equity company, and the day of closing, we did an immediate stock transfer to a handful. We actually did a stock transfer to every single employee in the company that started with us when we founded the firm to reward them. And that's knowing that when you sell to a private equity, they now own it, they control it, and they're probably going to reorganize and lay a bunch of people off relatively quickly, which is exactly what happened. But we went ahead and rewarded them by giving them stock at closing. So there's things that you can do as an owner if that path makes the most sense. But software, technology, biopharmaceutical, companies that usually private industry and or even in a third-party strategic sale, they're willing to pay multiples that a leverage transaction doesn't work for. You can't finance out of the cash flow of the company multiples that usually get above a 10 multiple.
And also companies, I know we look at balance sheets, and you want to be sure that there's not a lot of other debt. So if there's a lot of other bank debt and so forth, it may preclude them from having the cash flow to afford to do an ESOP.
They might have if you're a capital intensive company. So here's a perfect example. I came across a company was brought a transaction. Owners love their employees. They wanted to protect the legacy of the business, but they were in the heavy equipment rental space. So if you know that, Caterpillars, John Deere's, Komatsu's.
Very expensive.
They're always constantly, the strength of this company is they always had, their CapEx was so high.
New equipment, turning it over.
Every dollar of additional profit was being put back into new capital equipment, so they had no cash flow.
No cash flow to service an
Huge
ESOP.
EBITDA, but they had no profits.
Yeah.
I mean, the good news is they weren't paying any taxes because they were using 179 deductions to get rid of it all. The downside is they had no cash flow based on creating a value. Their value was the assets that they were worth, and that's not an ESOP transaction.
So when evaluating whether or not to do an ESOP, we have to first, I think, start with the owner's motivation. Secondly, examine the business, look at the profit and loss statement, look at the cash flow, can it service it? Third, look at the balance sheet, see is it capital intensive, how much of the debt is out there. What else? What else needs to be considered to see if a business is a good candidate?
Number of employees.
Number of employees and payroll.
Yep.
You're not going to do an ESOP if you have 3 employees and 2 of them are part-time. What's a good threshold?
I usually say 20 or more employees. A simple guideline, and there's ways around this, but I say 20 or more employees, and then for every 10 million of additional value of the company, another million of payroll. So it has to do with the way you fund and basically are releasing stock inside the ESOP for your employees. Because if you have too few of employees and too high of a value, and there's ways around, as I mentioned, there's ways to get around this, but it creates some complexity. But if you have too high of a value with too few of employees, it takes you so many more years to release the stock. So if I'm one of your employees and it takes 200 years to release all the stock, obviously, if I'm 60 years old, I'm going to be, my children will be long dead. My grandchildren will be long dead.
It's good to be lean and mean, but
correct.
Yeah, no, that's so true. When we look at opportunities for an ESOP, there is a certain pre-qualification. And Rick, I know you offer something where when an owner is considering an ESOP and you want to start to really look at it, sharpen your pencil, does this work from a numbers standpoint, everything else, you offer sort of an initial study to see if that is worthwhile. You call it
the industry calls it a feasibility study. I like referring to it as a blueprint. An engineering blueprint, because the industry we service predominantly understands that well. Nobody really understands what a feasibility study is. It means so many different things to so many people.
It does sound engineering.
But an engineering blueprint, I think, gives an understanding of what are we going to do? We're going to model out what a transaction looks like for you so you can get every single question you and any of your advisors would have. What does it mean to you and your family? What does it mean to your employees? What does it mean to the company? What does it mean to your management team? And ultimately, how is it going to flow? How does it cash flow? How do you meet your debt obligations? How do you meet your working capital, CapEx? How do you pay off the debt? And what is the stock value going to look like and the benefits for your employees over
It's a great first step. And I've seen your feasibility or engineering blueprints. Mm-hmm. It's a very low-cost way for an owner and their advisory team to frankly look at the ESOP design and say, is this thing going to work the way we expect it to work? I've seen you map it out so step by step that if a client makes a decision to move forward with it, the track has already been laid. And it's now a question of just walking through those steps and making sure that you can execute accordingly.
It is. It's a wonderful document that provides the capability of understanding what the impact is to all parties to help a business owner. Once they understand the philosophy of what they're trying to achieve, then it answers all the economic questions and the financial questions for themselves, for their employees, for their management team. And we tax affect that so you can see the various components of the tax benefits, both to the shareholder and ultimately to the company moving forward. Yeah. But it starts with one step before that as part of that same transaction, though, as you know, which is I think an owner needs to really understand for ESOP purposes, what is the business worth? What's the value of the business?
The valuation is key. That's
because as you and I have talked about.
That question weighs on everyone's mind.
You can love the ESOP.
What is this thing worth? And a lot of it depends who's asking.
Yeah. And
right?
So this
am I giving the asset, am I giving the business to my children? Well, then I want one value. Am I potentially selling to an ESOP? That's another value. Am I selling it to a third-party buyer? That's yet another. And that's perfectly okay and legitimate. Mm-hmm. There could be many different values depending on the purpose of that valuation question.
when a client's committed to looking at this and they're very serious about the idea of a liquidity, possibly an exit, but a liquidity succession strategy, and the ESOP is one of them, what we do first and foremost is value the business and deliver that valuation as part of ultimately the blueprint. But the reason we do it that way is so much effort is put into the modeling of the ESOP of all the components, which is, as you've seen, is between an 80 to 140 page deck with all the analysis and the modeling that comes through with that. With
and
all
a
the
summary on
pieces.
top.
Yeah, it really comes down to the
Boil it
focus of
down
about
into
12
English.
pages.
Right.
But all the documentation to support those
It's
12
gotta
pages
support
are
it.
built.
Right.
So we don't simply give those 12 pages. We provide the full documentation because
Yes.
a lot of our clients are engineers.
They're analytical people.
Or they're CFOs of companies that want to see
They're
all the
accounting and
documentation.
finance professionals. They want to know that everything hangs together.
Or they're the financial advisor who's astute working with the client that is analyzing multiple options for the client to determine, is the ESOP the best path?
And that's how we are objective. We look at all the applicable paths and help the client to get educated and figure out which path is best for them.
And I've seen the way you work with clients that we've done transactions for, because it's not just what is the ESOP going to do. You actually work with that client as part of the analysis that we do up front in that blueprint, and then starting to work with the client on the back end pieces, which is the estate planning, the gift planning, the charitable planning.
Yes, the charitable planning, what's going down to their children and so on and so forth. That's what I mean by kind of getting them all the way home, from point A to point B. So a lot of people that we work with, myself as a financial advisor with an exit planning specialist, but we also work with a lot of other financial advisors all across the country. How would you explain succinctly an ESOP to a financial advisor who wants to have a conversation with their client, their business owner client, to begin the conversation to explore an ESOP? How would you tee up that conversation?
First and foremost, I think every financial advisor needs to be able to have a basic understanding, not of ESOPs, but of the discussions that are needed to talk about the idea of future succession and liquidity and exit planning with clients.
Are we having that conversation? Because I think a lot of financial advisors are a little bit guilty of not going there. They're focusing on, let's say, asset management, things that they do day in, day out, and maybe not having those sometimes difficult conversations with their clients about, hey, well, what is your exit strategy? What steps have you taken? What's your preferred timing? And which of these exit paths? And if they're intrigued by the idea of an ESOP, how would you, again, kind of tease that a little bit further?
Well, it's important to have those conversations early on and continuously, because if you're not having it, somebody's going to have it with your client.
That's right.
And remind me before we finish, and I'll tell a story about a recent transaction that I completed where the existing client, the existing advisor of the client didn't bring me in. And you know the way I work. I'm loyal to those who bring me. In the South, we say, you dance with those who brung you. And so
brung you to the dance.
So the key is, in that case, a new advisor who met the client brought us in, and I'll tell the story later. But I want to get to the point of answering your question about how do you have that discussion. And I think part of that is whether it's early on and the client wants to have that discussion, or they're ready to actually start thinking about what are they doing from a succession and exit planning standpoint. It's getting back to talking about, what have you done in preparing the business for some type of liquidity event? Are you preparing yourself? When do you want to start looking at phasing back out of the business and starting to turn over your day-to-day operations to somebody else within the business?
Your timing, whom would you like to transfer it to?
And
at what value?
It is important to get full value for the business. Do you have an idea what the business is worth? And based on that, as an advisor, you should have a pretty good idea what the liquid net worth of the client is, so that you can incorporate that into some of the planning.
Know the whole person. What other assets do they have outside the business? I mean, you were saying, hey, 90% plus can be tied up in the business. Do they have other assets that they can rely on besides the business asset for liquidity?
And that brings us to a point of, years ago, I used to do a lot of speaking at financial conferences.
You still do?
I still do, but not focused,
right now.
Not just at financial services organizations.
Right.
But I was on a panel with a woman by the name of Kathy Abrams. You probably know her from your background. Kathy was the president of the International Investors Forum.
Sure.
And well-renowned. And she gave some statistics that resonated to me, because at the time I was a principal of a national broker dealership. And One of the comments that she made is they did a panel where they asked what they called ultra high net worth clients, which meant you had 10 million or more of investable assets with your advisor.
Yeah. I mean, Cerulli did a study recently. High net worth is kind of defined as 10 million in net worth and above. Ultra high net worth, 40 million and above.
Now this goes back to the 2006 to 2008 time frame.
So inflation adjusted, that's about right. Yeah.
So 10 million then was a lot of money. 10 million now, it's still a lot of money, but it's not what it was then. But the thing that hit me, and this is why I talk about the importance of having these conversations with clients early on and continuously, and not being an expert talking about you need to think about an ESOP. It's talking about and leading with the questions of, what are you doing? What are you putting in place? What are your thought processes? When do you want to step away from the business? But the reason why I say that is because the question was asked to the advisors about that work in that space. What percentage of the assets of those ultra high net worth clients do you manage? And of the panel of advisors that they interviewed, which were thousands of advisors with Merrill Lynch, UBS, independent advisors with various firms,
I think I know where this is going.
And the typical advisor, the study showed that the 87% of the advisors, I don't know what the statistics are today, I'm giving you what I heard and wrote down then. 87% of the advisors responded they control 95% or more of the client's assets for management. Then they went back to the clients and they said, of your net worth, liquid net worth that is managed by advisors, what percentage of your assets do you have managed by any one advisor?
It's got to be very small because the portfolio is a relatively small.
It was less than 25%.
Yeah, less than their overall net worth picture.
The disconnect in my mind is what the advisor thought they managed. Then the next question that they asked, which I thought was fascinating, is as a client, how many times a year do you want to be contacted by your financial advisor? Mm-hmm. Once a month, 12 times a year, I want to be contacted. But only 3 of those times do they want to be contacted related to financial, buying something, how your stocks are performing. It's more or less in this
relationship.
It's the relationship. It's getting to my point about the discussion about things outside of what you do day to day for your client, of managing their assets, handling their insurance and their risk profiles. It's talking about all the things. What are you doing from a legacy standpoint? How are you planning on taking care of the kids? As your business values continue to grow as part of your net worth, what are you thinking about and how are you looking at converting that illiquid value that you've built up in the business that is dormant, and that will continue to grow whether you take that money out or not in the form of cash to diversify. But let's start considering ways we can take out that liquidity and de-risk your balance sheet and put it into alternative strategies.
You look at the demographics, you look at the baby boomer generation, and literally there are, millions of baby boomers hurtling towards an age where they're going to be looking to exit their business one way or another. As I often say and write, what percentage of business owners are going to exit their business one day? Answer is 100%. Either vertically or horizontally, everyone's going to exit their business. And the question is, are they going to do it on their terms or someone else's? And we all know the war stories of people who held on too long, didn't do it, got sick or worse, and left behind a mess, and where there was a tremendous amount of value lost. And an ESOP is a wonderful succession plan with a built-in, potentially, if it's the right fit, group of individuals, employees, key management staff who want to succeed that business. So, Rick, what do you see as the future of ESOPs? Here, we're sitting here in 2026, and overall the economy is doing incredibly well. And what do you see the future of ESOPs for this country?
I think it's growing. We've had at Business Transition Advisors, BTA, we've had record years each year for the last 4. Every year is better than the last in the form of, and it's not about the revenue that we generate within the firm and the transactions we do. I'm talking about the wealth that we create for clients and their
lives
advisors.
That you're affecting.
And that's how I measure it. It's what the impact, and again, at 67 years old, I've been blessed in life, and So it's more about how I can impact society and the companies and the employees of our organization and the employees of other organizations to grow the wealth in securing their ability to comfortably retire. Because if you think about it, society today, the average American that works in this country retires with less than $100,000 in retirement savings and a $2,120 check a month in Social Security.
And who knows what the future of Social Security is.
I read something yesterday.
The federal deficit now is over $38 trillion.
And growing.
And growing. So either there's going to be an increase in taxes to raise revenue to fix that problem, or a decrease in services provided by the government.
And ESOPs aren't going to increase Social Security benefits, but what the studies show is that an ESOP will actually increase retirement benefits 300 to 500% over time for every employee that's an employee of an ESOP company. So that $100,000 benefit that an employee gets, and again, I'm not in the financial services industry anymore, but $100,000 annuitized when you're 65 years old over life expectancy is about $800 a month. So if we can increase that to $500,000, now all of a sudden you're increasing that benefit fivefold. So you're increasing it to about $4,000 a month. The positive is now you're creating a lifestyle at retirement where people are no longer living below the poverty line. They're maintaining their standard of living or improving it during the years that they deserve to be able to go ahead and benefit and live a quality life. That's what ESOPs are doing
Absolutely.
in America.
There's no question about it. It's going to improve the quality of life for workers. It's going to allow them to accumulate more wealth for retirement and hopefully to retire with dignity and financial independence. So let me kind of wrap up a little bit with this question. What advice would you give to business owners who are listening to this podcast, who are considering an ESOP based on all the merits that we've talked about, based on, having some of the components in place for it to be a right fit and be an appropriate path for them to consider? What key advice as they navigate this process, and what steps should they take to prepare for a possible ESOP?
First and foremost, I'd say they need to call you.
I mean
that in the context of, you and
they need to speak with a qualified advisor.
Correct.
Who's objective and who understands this area.
Who can take the time to understand the objectives of the client, to listen, ask the right questions, and to identify, here are your options from what I'm hearing. Because it's not always an ESOP, and it's not always hiring an investment banking team to sell the business. Sometimes it's just a management incentive plan. I'm trying to create my mindset. I love my business. I'm going to work at my desk the day I die. And when I die, I've already taken care of the planning for my family. I want to continue doing what I do, but these are some key people I got to take care of. So it's outside of the realm of an ESOP, but a good advisor listening carefully can decipher what is the objectives that the client is truly trying to achieve. And it's aligning the financial goals that you're trying to help the client achieve with the merits of their overall objectives and their overall long-term philosophy.
Their personal goals, their marital, their financial, what do they want to leave behind to their kids and so forth. It really takes a top-down view, as we often say, kind of going up in this helicopter and looking at their entire situation on a cross-disciplinary basis, both the business and the personal, and making sure that there's no gaps and that they're going to be able to get all the way home and achieve their objectives. And working with someone or a team of advisors who's going to look at their situation, as you said, Rick, ask the right questions, analyze their financial statements on the business side, analyze the personal information, and help them develop a plan that is workable, that they can understand, and that can be implemented in a timely basis before something happens that could take options off the table.
And that's, I think, a valid point. Taking options off the table is critical.
The sooner you begin planning, the more options you have.
Absolutely. And again, the key is not always having to pull the trigger to make the decision. It's understanding what those goals and objectives are.
And now you're in control.
Have the plan in place. And sometimes that plan can be triggered upon an event taking place, but at least you've done the planning up front to make that determination. And so getting back to one of the key questions you asked is, what is the driving motivation? Part of it is because of all the tax benefits we talked about, the ability to postpone and eliminate the capital gains tax from a selling shareholder. It's understanding the impact of that and the benefit of having that additional capital, that you're not defaulting in the form of unnecessary taxes that are, we're not talking about gray areas. This is legitimate, sound, fundamental, approved tax code. And it's one of the reasons why Congress passed Internal Revenue Code Section 1042 was to incent business owners to look at ESOPs because Congress knows that these are beneficial to society. It's beneficial to the workforce.
Good. Exactly right. And sometimes the tax code is in line with what's best for the people and to encourage behavior like things such as ESOPs.
So that is beneficial to the selling shareholder, but then the tax-free nature of the company being a tax-exempt organization, once they're back to an S-Corp or you do it as an S-Corp, and the ability of driving more cash flow to service the debt, to build up more wealth on the balance sheet, to create the ability to fund the cash needed for the repurchase obligation and the other benefits within the ESOP itself, to create the liquidity that is needed and protect the legacy of that business. Those are all of the things that help drive when you talk about why now with an ESOP. That's a big part of it. The other part is I think in America today, a large, vast portion of business owners started out working for a company, carrying a tool belt, being out in the field, working on a CNC machine in a manufacturing facility. And they worked their way up. They either worked their way up to buy the business or they worked their way up, learned it, and then went out and started their own business and have grown it.
The American dream, I call it.
Middle America has created incredible wealth through building these businesses, and they feel this incredible desire to give back to their employees, that they look at this company as their family. And it's one of the things I do when I talk to a business owner, and you've heard me talk about this. I ask the business owner, tell me and describe the relationship that you have with your employees.
Right.
And what do you think of them?
That's a very telling question. Are they a necessary evil? Oh gosh, one headache after another, or do they embrace their employees and have a sense of loyalty and wanting to give back and perpetuate a legacy?
Absolutely. Sometimes I turn it on them and I say, well, if I walked out to your facility right now and walked through your shop or your factory floor, what would your employees say about you and the relationship they have with you?
Yeah.
And when
are they feeling the love?
Yes. And when I hear them talk about, I get cards. We give presents to every employee and their children.
Mm-hmm.
It's when you hear things like that, that fundamentally they fit the philosophy of why this is important. At least
I was involved in a case a couple of years ago, Rick, and I know you've had these kind of experiences as well, where the owner of the company felt so strongly about implementing an ESOP and having ownership transition to their employees that he called everyone into a conference room, a pretty large conference room. And everyone sat down and there was an envelope on the table in front of them. And he said, I have a very important announcement to make today. I'm getting to a stage now where I want to retire, spend more time with my family, and I'm going to sell the business. And there was a hush over the crowd and all kinds of emotions and nervous and, oh my gosh, what's going to happen? What's going to become of me? And he says, the identity of the new owner is inside that envelope. Would you please open it now? And they opened up the envelopes, and inside it was a small handheld mirror. So they saw the reflection, and he said, you are going to be the owner of this company. And of course, everyone was relieved. There was cheering. There was, it was a magical moment where the owner felt that, hey, I can share this that I've built over the years and recognize the contribution that the employees made towards the success of that business. So, Rick, I think we're gonna wrap it up. I think you've done an outstanding job. Thank you so much for coming up from Florida to visit with us in studio in New Jersey and share the wealth of knowledge that you have as a business owner, an entrepreneur, an ESOP expert, a participant in an ESOP plan, and someone who sits on the board of ESOPs. I can't think of anyone more qualified on this topic. So I absolutely appreciate it, appreciate you. And I want to thank everyone for joining and spending time on One Way Out, the podcast, where we will continually and in future episodes dive into these different options. I mean, an ESOP is a win-win on so many levels for the owners of a business, for the employees of the business, for the company and the community it serves. There are a number of different, exit paths, and we're going to continue to explore that. We appreciate Rick being here today, and we appreciate you listening and participating. So thank you.
Thank you, Dan. Thank you, everybody, for participating. Appreciate your time.
And that's a wrap on this episode of One Way Out. If today's conversation sparked something for you, share it with a fellow business owner who needs to hear it, and make sure you're subscribed wherever you listen so you don't miss what's coming next. You can find more resources and connect with Dan at www.yourOneWayOut.com or www.equitystrategiesgroup.com. Until next time, keep building.